In this video, we're going to look at the Swiss National Bank, how to find the central bank meeting, and also how to interpret the central bank graphs which they give out with their central bank statement. So let's jump over to the SNB website. The links to the website and the monetary policy aspect of the Swiss National Bank will be in the accompanying PDF. So just notice here, Swiss National Bank, what you're looking for is SNB, and then you're looking to click on monetary policy. Now, that monetary policy comes up to this page, and you can see that the decisions are stacked year by year in order here. And you can see here, here's the monetary policy assessment for 19th of June 2025. You just go over to it here, and here you see the assessment. Now, as with all statements, you can see the decision, and this is what you're looking for any hints as to what the central bank is looking for. So again, remember, this is just specific for this time and place, but the same principle applies for all future meetings. So you read through this meeting, and you would have noticed the uncertainty that a lot of central banks have been noting as we've been looking at these monetary policy statements. And what we're looking for here is any hints about what the SNB is looking for. And you can see here that they've got inflationary pressure has decreased. And they said with today's easing, right, of monetary policy, the SNB is countering the lower inflation pressures. Right, so they've lowered the rate from 0.25 to 0%. You see, they're trying to give a little bit of expansionary environment to lift inflation. And says the SNB will continue to monitor the situation closely and adjust its monetary policy if necessary to ensure that inflation remains within the range consistent with price stability over the medium term. Right, inflation has declined further. This decline was mainly attributed to decline of tourism and all products. So what you're looking for here is if you had a lower than expected inflation print, then that means that SNB might be moving towards negative interest rates. Right? They have used negative interest rates in the past, and the prospect is they'd have to use it again. So you can see here that they're trying to lift the inflationary pressures in Switzerland. Now, if you take a look here, this is their monetary policy assessment, and you can just click on this PDF, right? And you can download that monetary policy assessment. And what you're looking for here, okay, you get the statement, but you also get these very helpful inflation forecasts. And you see here that the inflation forecast changes between the previous decision and the current decision. So it shows you the current decision in red, previous decision in yellow. Do you see how they see inflation moving lower? You can see that by looking at the forecast here. March 2025, they had inflation, 0.8, 0.8, 0.8 for all 2026. Look, and then it's gone down to 0.4, 0.5, 0.5, 0.6. So by looking at these conditional inflation forecasts, you can get an idea of what the SNB is thinking for inflation moving forward, and that can be very helpful. It helps you to see that. Now, what you're looking for, if that's a big unexpected drop or a big unexpected rise, the Swiss franc can move on that. So the key thing for you to realise is where to find the monetary policy assessment, and then these inflation forecasts which accompany the monetary policy decision. They're on the back of the statement. And you can just click on that one there, and you get a PDF with the whole statement plus the forecasts, which are very helpful. And markets can move on this, so keep that in mind for the Swiss National Bank. We're now going to look at the Bank of Canada. Now, the Bank of Canada has a website like all other central banks. And what we're looking for here with the Bank of Canada is where you find the monetary policy decision. Like all the other previous central bank overviews, the PDF will show you the website for the Bank of Canada and the website for the monetary policy decision. Now, what you're looking for here is the policy interest rate. And you can see here the nice thing about the Bank of Canada, you've got a nice handy kind of graph which shows you how the policy decisions have been over the last few decisions, and you can see that here it's all laid out fairly neatly in a table. But what you're looking for here is these interest rate announcements, right? And you see that you get the monetary policy report every other announcement, and then you're just looking on here June the 4th, and there you go, that gives you the decision. And again, you're reading the detail and you're looking to see within the statement, what is the Bank of Canada really focusing on? And by looking at what they're focusing on, you can find those key economic data points that are likely to move. Obviously, uncertainty about tariffs. This is during Donald Trump's tariff season, and you can see economic growth, housing activity, inflation. And again, inflation rose slightly stronger than the bank had expected. Right, the bank's preferred measure for core inflation as well moved up. Right, so straight away you can see that inflation's moved up, and their preferred measures of core inflation, that's the trim and the median, right, have moved up as well. So, in other words, with the Bank of Canada, with them cutting interest rates. And so in June, they're saying inflation's moved up. It's just going to mean they're a bit stickier. So that tells you if you get a surprise miss in inflation to the downside, they're going to be more likely to be cutting interest rates again, particularly with slowing growth. So once again, simple process, looking at the Bank of Canada, looking at the monetary policy assessment, and this is the Bank of Canada. And of course, as we looked at with the currencies, oil prices are very important for the Canadian dollar, and you can see, that you'll also get a little review on what they're thinking about oil prices, because that so impacts the Canadian economy. Now, the Reserve Bank of New Zealand calls its interest rate decision the official cash rate decision. This is shortened to OCR. So whenever you see the OCR out of the RBNZ, it's talking about the interest rate decision by the Reserve Bank of New Zealand. The website is in the PDF link provided and the monetary policy link. So here on the website, you can see the official cash rate decision is there, and you've got the link to monetary policy. So you want to click to monetary policy, and when you go to monetary policy, you want to click on the statement, and then you get the latest monetary policy statement there, and you download it here. Okay, so you can see that's the last statement. Now, it can be a bit fiddly, the Reserve Bank of New Zealand monetary policy statement, to find the relevant details. So once you've downloaded it, you get the decision. Now, the decision is fine, right? That's fairly straightforward. You can see here, May 2025. It tells you they've lowered it, right? They say core inflation is declining. They can see inflation targets consistent. New Zealand's recovering. High commodity prices, lower interest are supporting overall economic activity. Remember, we've looked at the commodities in the New Zealand dollar section, how it's a commodity-driven economy, sort of a little bit like Australia's little brother. Obviously, that's no offence meant to New Zealanders, but just in terms of currencies, if you know what I mean, with the US dollar being the king of currencies, the New Zealand dollar kind of shadows the Australian dollar due to its high commodity export levels. So you can see they're just recognizing that. And then you can see a policy uncertainty, both tariffs and increased policy are expected to moderate New Zealand's economic recovery, reduce medium-term inflation pressures. However, there remains considerable uncertainty around these judgments. So you can see that they're saying inflation was in the target band. So straight away, you can realize that if you got a much higher than expected inflation reading, okay, that could really surprise the Reserve Bank of New Zealand, and that would be a potential tradable opportunity. Remember, this is going to change. So each time you're going to go into the statement and see what are they talking about? What are they focusing on? That's how you find those economic data points that are going to trigger the market. I wanted to demonstrate to you the good practice, and that's something you can easily do. here, the trick with the Reserve Bank of New Zealand is it's huge, the statement. You look at all the details that come through, right? I would recommend you to read this, especially when it talks about the global outlook. Reading what central banks think about the global outlook will also educate you and help you in understanding the global outlook. But there's one element of this statement that's really important and will often be reported by markets, but you find it at the very end of the kind of statement. It's on the final chapter in the appendices, and it's these statistical tables. And what you're looking for here is they give these projections about where they see the OCR, right, the official cash rate. So what they're saying is, if you look at the top of the decision, you can see, okay, they've lowered it to 3.25%. So at 3.25% is the current interest rate. Now, if you go back down here to their tables that they've put, they tell you where they see the official cash rate. So, right, they see it could go up 3.4, and then they see it going down again December. So when this is released, there's expectations about what these projections are going to be. Now, this is where the surprise comes in. Say markets were expecting this, okay, but then say instead of this 2.9, it came in at 2.4, and this was at 2, this was 1.8, then all of a sudden there'll be a surprise. So with the Reserve Bank of New Zealand, look at this official cash rate, and you need to find some analysis on what that's expected to be. Westpac are a good analyst house for New Zealand data, and find some good New Zealand analysts. There will be look at some sort of Southern Hemisphere investment houses. They'll often have an opinion on what they're expecting this official cash rate to be. Also look at the inflation and the unemployment. So that shows you what they think is coming for the economy. That helps you set that macro outlook. And you can see here, inflation expectations. But it's this one that gets reported often. The inflation level, particularly relevant at the moment, and the official cash rate. Difficult to find because it's right at the back. So either you get a professional news feed that just automatically churns it out, or you can have a look at it there and you get the monetary policy statement. So that's what you're looking for. Remember, monetary policy is here, official cash rate. You've got a nice little chart. You've got a lot of charts on the RBNZ's website, and then past monetary policy decisions are here. And you can look what those past decisions were, media release, statement, media conference, and you can look at those decisions. Okay, folks, I hope that helps. And that is a look at the Reserve Bank of New Zealand. Don't forget to check out the PDFs so you can see all the links and you can do this research yourself. In this module, I'm going to be explaining to you the difference between fundamentals and sentiment. At first, it is easy to confuse the two, but over a little bit of time with some explanation, it does become clear what the differences are. In a nutshell, fundamentals are longer term and more systemic. Sentiment is shorter term and more transient. We're going to be unpacking that over a series of lessons, and I'm going to be explaining it in a few different ways. So in this lesson, what we're going to look at first of all is to look at what actually are the fundamentals, and that's going to help us as we look at this question. So the way to understand the fundamentals is they're essentially the core underlying economic and financial factors that are influencing asset prices. If you had to think about it like health, for instance, what's the fundamentals of health? It would be things like a healthy diet, a good sleep, regular exercise. If you do those basic fundamentals, you're more likely to be fundamentally healthy. And in a similar way in the financial world, the fundamentals are looking at measurable data for a country, like, is the economy growing? What's happening with interest rates? Is the central bank increasing interest rates or cutting interest rates? How about inflation? Is it steady around the 2% target, or is it ballooning out of control or too low and deflationary. These fundamentals are exactly the same for companies. Are they earning well? Are they projected to keep earning well? Do they have a good product market fit? Is there plenty of demand for their products? When you look at the core underlying fundamentals, it tells you the general health of something. And that's exactly the meaning of fundamentals for countries and for currencies. Now, the fundamentals matter because they shape the long-term valuations. And central banks, when they're setting their interest rates, use them to set policy. Is inflation falling or is it rising? Is the jobs market strong or is it weak? Is GDP growing or is it shrinking? And investors use these factors in order to decide whether to buy or sell a currency, a commodity, company stocks or shares. It's the same principle. And fundamentals often determine whether a trend is sustainable. Okay? Now, the key sort of categories that you need to look for are things like monetary policy for currencies, and in particular, interest rates. Remember, we've looked at, is the central bank in an expansionary, contractionary, or neutral stage? Are interest rates being increased, decreased, or being kept flat? Then you want to look at things like quantitative easing and quantitative tightening. Is the central bank trying to boost the domestic economy by using quantitative easing, and that weakens the currency? Or is it embarking on a period of quantitative tightening? These are the fundamentals that undergird the whole fundamental outlook for that country and that currency. Then you want to look at some of the major macroeconomic data. The labour market. Are jobs being added to the economy month by month by month? That's good. Or are jobs falling from the economy month by month by month? That shows a weakening in the labour market. What about GDP? Is it growing? And is the central bank expecting it to keep on growing? Or is it contractionary? How about inflation? Is inflation rising and it's expected to keep rising, or falling and expected to keep falling? They're the kind of big macroeconomic data points that traders and investors are looking at to try to get a sense of the fundamentals. Then you want to look at things like fiscal policy. What is the government doing? Is the government trying to boost growth? Is taxation going to be increased? If it is, then that could hinder growth. What's the government spending going on? Is the government about to embark on a huge infrastructure project to boost productivity in the medium to longer term? It's exactly the same principle for companies. What's their earnings? What's their margins? What's their debt? How's that projected to go? These are fundamental principles, and they undergird the whole of the outlook for a particular country's currency. Okay, that's what you're looking at. That when we're talking about fundamentals, that's what you're looking at. In a nutshell, it's what the data tells us. Okay, and what the expected data is going to be telling us. Now, how does that differ to technicals? Now, this is relatively simple. Technicals is just what's happening on price. So as a CMT charter holder, I've spent a lot of time looking at technicals, and I use them. They're very, very useful. But I use them in line with fundamentals. So technicals would be like when you see, hang on, what I like to do is I like to find, okay, I've got a strong reason why I'm expecting this currency to move in that direction. Now, how can I make sense of it technically so I can limit my risk? That's what I'm primarily trying to do. Where am I technically wrong? Okay. And what the technicals do is they look at the price movements on charts. They find, good areas to potentially enter, where it would be sensible to exit, where it would be good to take profit. It's much more sort of price based and specific. Whereas the fundamentals is a much broader principle based on much broader, wider data. So both are important and both have their place, but they have different spheres that they operate in. And fundamentals are essentially explaining why the price should move over time. Now, one of the weaknesses with a fundamental outlook is you might have a very good fundamental reason for price to keep going up, but sometimes price can go down for far longer than you'd like it to. That's where technicals come in to help, okay? Because you think, okay, well, hang on, price shouldn't have gone down here if I was right on my fundamental. I can exit for a controlled loss there and then re-enter if it starts moving in the direction I'm expecting it to. So both have their place, both are important. So, some people look down and say, oh, I only use the fundamentals. Some will I only use the technicals. There is a place for both of them, and finding that sweet spot is something that I try to do. Now, when you're looking at the fundamentals as a trader, you're trying to look at broad trends and economic indicators. What's generally happening? Is growth starting to pick up? Is the labour market generally weakening? Is inflation falling lower? What's expected to happen? That's what you're trying to do, look at the trends. And then you're using those economic trends to try to postulate, well, what might the central bank do next? So for instance, at the time of making this video, I know that the Bank of England is really, really sensitive to a weakening labour market. And if the labour market starts to show weakness, I know that the Bank of England is being more likely to cut interest rates, right? So you can see, okay, labour market weakening, the Bank of England tells you we're worried about a weakening labour market. And then when you get the weakening labour market, what do you see? The pound fall. Right? So, you focus on what data means for inflation, growth, policy. What is the central bank focusing on? That's what you want to focus on. And then you use those fundamentals to build a macro narrative. Now you can go into this in a lot of depth, and a lot of detail, or you can go into less detail. The more depth and detail the better your overall framework is, and that can add to your conviction, particularly with things like, swing trading. So, in practice, fundamentals in practice would be something like, you see a strong jobs data report, that's likely to support currency. Even more important is the central bank focusing on it. If the central bank's saying, we want to see jobs improve before we look at hiking interest rates, then all of a sudden, if jobs improve, then, interest rate hikes are going to be speculated about and the currency is going to grow. Here's another one, higher inflation, right? So if the central bank says we're concerned about high inflation and we don't want to see it moving in the wrong, we don't want to see it moving higher, then all of a sudden you have a high inflation print. What's that going to do? Increase expectations that the central bank is going to hike interest rates, and by hiking interest rates, right, it's in that contractionary territory, and you can expect the currency to rise. Okay. What about falling GDP? Maybe a central bank says we're concerned about growth and we may need to cut interest rates more deeply than we previously expected. Then all of a sudden there's a GDP print and it's lower than markets were expecting. Then all of a sudden rate cutting expectations grow and the currency falls. So remember, what I want you to see, and you should be understanding this by now, it's not just the number, it's not just the data, it's not just, oh, this is important, that's important, oh, jobs data is always important, inflation. No, it's the context. And remember, that context is derived from what the central bank is telling you. Now, the difference between fundamentals and sentiment is fundamentals are sort of telling you what should be happening, but sentiment is really the mood or tone of the market at that time. Now, we'll look at how sentiment interacts with fundamentals to drive price action in our next lesson. But think of it a bit like this. When I said about that first example, the fundamentals of health, I know, I'm not a doctor or anything, but we know the basic things that are fundamentals of health, a healthy diet, sleeping well, exercising well, being social, those kinds of things are all good indicators of fundamental health. So say you regularly eat well, you regularly sleep well, right? You regularly spend time with other people, and you're doing the right things for your health. Fundamentally, health is good. Now, you might have one night you eat terribly, right? You overindulge, you don't sleep very well, and you spend 48 hours on your own in a room or something. Okay, now that short-term sentiment is, oh gosh, that's terrible. That's terrible. But fundamentally, all that work you've done is not going to suddenly be eroded by 2 days of being out of step. Do you see what I mean? So the short-term sentiment will be, gosh, terrible. But your long-term fundamentals are good. It's exactly this same way the vice versa. Say fundamentally, you don't sleep well, you don't eat well, you're antisocial, you're doing all sorts of things that are harming your health, and then you have a weekend away at a health farm. You know what I mean? Like, okay, fundamentally, your life's poorly, and you've had 2 days of being away, but that's not going to change the fundamentals. As soon as you go back to normal life, you're going to go back to your old ways. So that's kind of the difference in fundamentals and sentiment. That example might help. It might not help. It might not be helpful for you at all. And that's fine because we're going to explain it in different ways. And we'll start looking at sentiment in the next section.